All right, welcome back to the deep dive. Today we're going depth on something pretty fundamental, commodities.
Oh, yeah. The building block.
It might sound, like trading floors and crazy charts, but honestly, understanding these raw materials, I think, gives you a pretty interesting perspective on the whole global economy.
For sure.
You ever get that feeling like you're missing something when you read about inflation or, global trade and stuff?
Yeah.
Commodities can be that missing link.
It really is.
And
I think so.
it can feel overwhelming.
Yeah.
But our goal is, can we break this down in a clear way
Yeah.
so you can build up this understanding without getting lost in the jargon?
Exactly. Think of it as like your guide to unlocking these markets. And specifically, we're looking at the book Getting Started in Commodities by George Fontanills.
Right.
And we're really trying to pull out the essential knowledge to help you understand and maybe even trade,
Yeah.
These key commodities like natural gas, crude oil, aluminum, zinc, copper, silver, gold. So consider this your shortcut to the core concepts.
I like it. And, this isn't about reading the whole textbook cover to cover.
Yeah.
This book, it was written in 2007.
Yeah.
But it's really designed to be a practical guide, whether you're totally new to commodities or
Right.
you've already started exploring a little bit.
Right.
It gives you that structure.
Mhm.
It goes through, the fundamentals, the technical analysis,
Yes.
risk management, even that psychology of trading, which a lot of people forget about.
It's so important. And I think the first step is really understanding why commodities matter in the first place.
Yeah.
These are the raw materials that our lives depend on. You think about the energy we use, the metals in our electronics, our buildings. These are not just things that people speculate on. They're essential parts of our world, and they play a part in your financial picture too.
Mm-hmm.
Like hedging against inflation,
Yeah.
offering diversification, because these things, their prices don't always move with stocks and bonds.
Mm-hmm. Right. They're their own thing.
They're their own thing.
So let's break this down from the very beginning. What is a commodity? Like, what are we even talking about?
Okay, at its core, it's a standardized, interchangeable good. It's traded in bulk.
Yeah.
So think about gasoline, 1 gallon of unleaded. It's basically the same no matter where you buy it.
Right.
That standardization is essential for these markets to work. It makes trading on a large scale much, much simpler.
Right, because you're not trying to figure out, is this barrel of oil better than that barrel of oil? It's a standardized thing.
Right.
And we hear about different types of commodities.
Yeah.
What are those main distinctions?
So broadly speaking, you've got your hard commodities.
Yes.
These are the natural resources that are extracted. So we're talking about crude oil, natural gas, and the metals, gold, silver, copper, aluminum, even zinc.
Got it.
And then on the other side, you have soft commodities. These are the agricultural products. So grains like wheat, corn, soybeans, and livestock as well.
Okay, so the oil and gold we hear about so much, that's dug out of the ground. Whereas,
Mhm.
the food on our table, that kind of falls to that soft category.
Right, exactly.
Okay, now Fontanills talks about these 3 transformational aspects of commodities. That sounds kind of complex.
It is.
What does that mean for us?
So this is where it gets interesting because it shows you that the value of a commodity isn't just about the material itself.
Okay,
So first you have space or location.
right.
The value of a commodity can change drastically depending on where it is.
Okay.
So think about crude oil again. The price at a major hub like Cushing, Oklahoma, it becomes a benchmark.
Yeah.
And the reason is transportation and logistics play a huge role. Getting a commodity from where it's produced to where it's needed, that costs money and it affects the final price. So when you're looking at a commodity, remember, it's not just about what it is, it's also about where it is.
So like a pile of aluminum just sitting in a mine in the middle of nowhere. It's not going to be worth as much as that same pile sitting at a manufacturing center where they need it right now.
Precisely. And then you have the second aspect, which is time.
Okay.
And this is important because the value of a commodity isn't static over time. You have things like storage costs. Think about the tanks you need to store oil, the silos for grain. That all costs money.
Right.
And then interest rates also factor in, and of course the expectations of future supply and demand.
Makes sense.
So a perishable commodity like fresh produce has a very different dynamic than a storable commodity like, say, gold.
Right. A farmer can't just hold on to his fruit forever
Exactly.
and expect it to be worth the same amount
That's
later
right.
on.
Right.
And the third aspect.
The third aspect is form or quality.
Okay.
And this refers to blending and processing. Because, you can take raw commodities and transform them to meet certain quality standards.
Okay.
and that creates value and different market characteristics. For instance, crude oil. It's not just generic barrels of oil. There are different grades based on sulfur content, density.
Yeah.
Refineries, they blend these different crudes to get specific types of gasoline or junk fuel, for different purposes.
Sure.
So the specific form a commodity takes really impacts its value.
So commodities are more than just these basic materials. Their value changes based on where they are, when they're available, and what their specific characteristics are.
Exactly.
It's a lot more nuanced than I think people initially realize.
I agree.
Okay, so how do these markets actually work? We hear about spot prices and futures.
Right.
What's the big difference?
So you have a couple of levels. You have the spot markets, also called cash markets, and this is for immediate delivery of the commodity.
Right now.
Right now.
Yeah.
The price you see reflects the current balance of supply and demand, and these markets are really important for the businesses that actually use these commodities.
Like a power plant buying natural gas to generate electricity today.
Exactly.
They need it right now.
Yes, exactly. But then you have the futures markets, and this is where it gets really interesting, especially for people who want to, participate in the market.
Right.
These markets trade standardized contracts for future delivery of a commodity, and the price is agreed upon today. So these futures markets are key for a few reasons. First, it's a major mechanism for price discovery. It helps us understand what the market expects prices to be in the future. Second, they're crucial for hedging, which allows producers and consumers to lock in prices and manage risk.
So a gold mining company might sell a futures contract to guarantee a certain price for the gold.
Exactly.
Even before it's mined.
Precisely.
Just to protect themselves.
Yes, exactly. And then, of course, futures are also used for speculation where people try to profit from price movements.
Right. They're betting on the future price.
Exactly.
Now, what are some of the important things to know about futures trading?
Well, futures contracts are standardized by exchanges.
Right.
So they define the exact size of the contract, like 1,000 barrels of oil, the grade of the commodity, where it can be delivered, and when the contract expires. This standardization is key because it makes trading much more efficient.
Makes sense.
Now, you also often hear about margin and leverage when it comes to futures.
Right.
And this is important to understand. Margin is essentially a good faith deposit. It lets you control a large contract value with a smaller amount of capital.
Okay.
So this creates leverage, which can amplify both gains and losses. It's different than buying a stock where you typically pay the full price up front.
Right. It's more, I guess you could say, risky,
It is riskier.
but also potentially more rewarding.
Yes, exactly. You have more upside potential, but also more downside potential.
And you mentioned this entity called a clearinghouse.
Right.
What do they do?
So the clearinghouse, they're essential because they act as an intermediary and they guarantee the performance of these contracts. So this reduces the risk that one party just won't deliver or pay.
Right. So it adds a layer of trust to the system.
Exactly.
And I always hear about contango and backwardation. They
Right.
sound very technical.
They are a bit technical.
Can you break it down for us?
Sure. These terms describe the relationship between the spot price, which is the price for immediate delivery,
Right.
and the futures price.
Okay.
So in contango, the futures price is higher than the spot price. This often reflects the costs of storing the commodity over time, things like warehousing, insurance, and interest. It can also reflect expectations that prices will be higher in the future.
So if it costs money to store oil,
Yes.
the price of oil for delivery in 6 months might be higher than the price today.
Exactly.
Covering those costs.
Exactly. Backwardation is the opposite. Here, the futures price is lower than the spot price. This usually means there's strong demand right now or a potential shortage.
Oh, I see.
People are willing to pay a premium to get the commodity right away.
Interesting. So these price relationships can actually tell you something about what the market's expecting.
They can, yeah.
That's really helpful.
It is.
Now, what about options markets? How do those fit into the picture?
Options on commodity futures give the buyer the right, but not the obligation, to either buy or sell that futures contract at a set price.
Okay.
It's called the strike price, by a certain date, which is the expiration date.
Right.
And for this right, the buyer pays a premium. Now, options can be used in a bunch of ways: for hedging, for speculation, and even for generating income.
So if I'm worried about the price of natural gas falling,
Right.
I could buy a put option.
You could
That kind of protects
exactly
me.
a form of insurance.
I like that.
And you also have all the different participants in these markets. You have the producers, the ones actually getting the commodities out of the ground or growing them. They use futures and options to hedge against price swings.
Right.
Then you have the consumers, the manufacturers, the end users.
Right. They need the material.
They need the materials, exactly. And they use these tools to protect themselves from price increases. Then you have the speculators. They're trying to profit from price movements, and they actually provide important liquidity to the market.
Okay.
And finally, you have arbitrageurs, who are constantly looking for tiny price differences and exploiting those differences. And that actually helps keep the markets efficient.
So it's a whole ecosystem.
It is. It's fascinating.
Now, direct commodity trading with futures and options, it sounds pretty involved. What if someone wants to get into commodities, but in a way that's more like, the traditional stock market?
Right. So you could get indirect exposure by investing in companies.
Okay.
So, for example, you have commodity producers. These are the companies that mine the metals, drill for oil, or work in agriculture.
Right.
When commodity prices go up, their profits often go up too.
Right.
And that can lead to higher stock prices.
So if I buy stock in, say, a copper mining company,
Yes.
I'm getting exposure to the copper price without having to trade futures?
Exactly.
I like that it's a little more, I guess you could say, hands-off.
It is, yes. You also have commodity processors and distributors. These are the companies that turn the raw commodities into finished goods.
Okay.
Like, think about oil refiners or food processors.
Right, so they take the crude oil and turn it into gasoline.
Exactly.
Or take the wheat and turn it into bread.
Precisely.
Okay.
Their profitability is also linked to commodity prices, but it's also influenced by their processing margins.
Right, how much they can charge for the finished product
So.
compared to how much it costs them to get the raw material.
Precisely.
So what are the advantages and disadvantages of going this indirect route?
So the main advantage, I think, is accessibility.
Right.
It's much easier to buy shares of a company.
Yeah, through your brokerage account.
Exactly. Than to trade futures. It can also be less volatile, and some of these companies pay dividends.
Oh, that's nice.
But the correlation with the actual commodity prices, it's not always perfect.
Right.
A company's stock price is influenced by lots of things, not just the commodity price.
Right, like management decisions.
Right.
Or whatever's going on in their specific region.
Exactly.
Okay, now what about commodity index markets and ETFs?
Right. So this is another way to get exposure.
Okay.
Commodity indexes are basically benchmarks that track the overall performance of a basket of commodities.
So instead of just buying oil,
Right.
I could buy a basket of energy commodities.
Exactly. And these indexes are often based on futures contracts. You'll see names like the S&P GSCI or the Bloomberg Commodity Index.
Right, and they give you a diversified picture
Yes, precisely.
of what's going on in the market.
Right.
Now, commodity ETFs, they allow you to invest in these indexes.
Yes.
Right.
They're like mutual funds that trade on exchanges.
Right, so it's like buying a stock.
Exactly. And they can track either these commodity indexes or sometimes even hold the physical commodity like you see with certain gold ETFs.
Okay.
So they offer a really liquid and easy way to get exposure. You can find broad commodity ETFs that cover a wide range of commodities
Right.
or sector-specific ETFs that focus on, say, energy or metals.
Now, you mentioned earlier these futures-based ETFs and this roll yield.
Yes.
What is that?
This is an important point if you're looking at ETFs.
Okay.
Since these ETFs hold futures contracts, they don't actually take delivery of the commodity. So as those contracts get close to expiring,
Right.
the ETF has to sell them and buy new ones further out in the future.
Got it.
This is called rolling.
Right.
And the roll yield is basically the profit or loss that happens during this roll.
Okay.
So if the market is in contango, where those later dated contracts are more expensive,
Right.
the ETF is basically buying high and selling low,
Oh, that's not good.
which can hurt your returns over time. And the opposite is true in backwardation, where you can actually have a positive roll yield.
So that shape of the futures curve,
Yeah.
whether it's contango or backwardation, can actually affect the performance of those ETFs.
It can, definitely.
And what about the ETFs that hold the physical commodity?
Right, so those mainly exist for precious metals like gold and silver. They actually hold the metal in vaults,
Okay.
and they try to track the spot price of the metal.
So they don't have to worry about that roll yield.
Exactly, because they're not dealing with futures contracts.
Okay, that makes sense. So If I'm trying to decide between ETFs and futures, what are the pros and cons?
Okay, so for ETFs, the big advantage is diversification.
Right.
They're very liquid. You can trade them easily like stocks.
Right.
You don't need as much capital to get started.
Okay.
And you don't have to deal with margin calls or managing futures contracts.
So they're good for like the average person?
Yes, for a long-term investor who wants exposure without the complexity, ETFs can be a good option.
Got it.
But you are getting indirect exposure, there are expense ratios to consider, and that roll yield can have a big impact.
Okay.
With futures, you get more direct price exposure, you can use leverage, and the expense ratios are usually lower. But the risk is much higher, you need more capital, and it's definitely more complex.
Right. You really have to know what you're doing.
Exactly.
All right. So we've covered what commodities are, how to get exposure.
Yeah. Now, how do we analyze these markets to make smart decisions? Fontanills talks about fundamental analysis.
Right.
What do we need to know there?
So for commodities, fundamental analysis is all about understanding supply and demand.
Okay, that makes sense.
You need to look at the factors that affect how much of a commodity is available. That's the supply side.
Okay.
And how much people want to buy, that's the demand side.
All right, so let's start with supply.
Okay, on the supply side, you've got things like production capacity.
Right. How much can actually be produced?
Exactly. From existing mines, oil wells, refineries. Weather events are a big factor, especially for energy.
Right. Think hurricanes?
Hurricanes, exactly, or cold snaps. Those can disrupt production. Geopolitical instability, that's another huge one, especially for energy and some metals.
Right. Wars and trade disputes can really mess things up.
They can. Technological changes can play a role as well, new extraction techniques.
Right. Finding new ways to get the commodity out of the ground. Exactly. Or even finding new sources for a particular metal. And then, of course, inventory levels.
Okay, so that's like how much of the commodity is sitting in storage.
Exactly.
Okay.
For oil and gas, you have the EIA, the Energy Information Administration.
Right.
They release weekly reports that the market watches very closely.
I've seen those.
For metals, you have reports from exchanges like the London Metal Exchange that give you insights into the available supply.
Got it. So lots of data to keep track of.
There is, yeah.
All right. Now, what about demand?
So on the demand side, global economic growth is a huge driver, especially for industrial metals and energy.
Right, because when economies are growing,
yes,
they need more materials.
Exactly. They need more materials to build things, to manufacture things, to transport things.
Yeah.
Population growth contributes to long-term demand.
Right. More people, more demand.
Exactly. And changing consumer preferences also matter, like the rise of electric vehicles.
Right.
That's boosting demand for battery metals, like lithium.
Right. All those batteries.
And government policies like infrastructure spending or environmental regulations, those can have a big impact too.
So it's really about understanding the specific drivers for each commodity.
It is, yeah.
Oil is going to have different drivers than, say, gold.
Exactly.
Okay, that makes sense.
And Fontanills really stresses that you need to look at these key data reports.
Right.
And develop your own sense of the overall balance.
Between supply and demand.
Yes, exactly.
Okay, now, technical analysis. What's that all about?
So technical analysis is about studying price charts and volume data.
Right. Looking for patterns.
Exactly. Looking for patterns that might suggest where prices are headed.
Yeah.
And one of the key things is trend identification. You can use tools like trend lines, which connect a series of highs or lows or moving averages, which smooth out the price data to show you the prevailing trend.
And commodities often have those strong sustained trends.
They do. And that's why these tools can be particularly useful.
Now, what about support and resistance? What are those?
So support and resistance levels are price levels where historically buying or selling pressure has been strong enough to prevent the price from moving further in that direction.
So they act like barriers.
They do. They act like barriers. Identifying these levels can help you anticipate where prices might stall, reverse, or break through.
Okay.
And then you have all the technical indicators that traders use.
Right.
Things like moving averages, which we already talked about. The RSI, the Relative Strength Index, which measures momentum.
Okay.
Stochastic oscillators, which also look at momentum.
Okay.
The MCD, or Moving Average Convergence Divergence, which helps identify trend changes.
Got it.
And volume analysis, where you look at the volume of trading to confirm the strength of a move.
So it's a whole toolkit of indicators.
It is, yeah.
What about chart patterns like triangles, head and shoulders, all that stuff? Are those relevant for commodities?
They definitely are, and Fontanills talks about this a lot. You have all these patterns that have emerged over time. Triangles, flags, head and shoulders, double tops and bottoms. These can all suggest future price direction based on how prices have behaved in the past.
So if you see a certain pattern,
Yeah.
it might tell you what's going to happen next.
It might, but it's not foolproof.
Right, of course.
It's important to remember that technical analysis is a tool,
Yeah,
and it's often most effective when you combine it with your fundamental outlook.
it all works together.
Exactly.
Now, Fontanills also gets into something called Elliott Wave theory. I've heard of that, but it sounds complicated.
It is a bit more complex, but it's really interesting.
Okay, what's the basic idea?
So the idea is that market prices move in recurring wave patterns.
Like waves in the ocean?
Kinda, yeah.
Right.
But these waves reflect the collective psychology of investors, how optimistic or pessimistic they are.
Okay.
And the theory says that these patterns repeat themselves, but on different timescales. So you might see a similar pattern over a few days,
Right.
and then a similar pattern over a few months.
Okay, so it's fractals.
Exactly, it's fractals. The basic pattern is 5 waves in the direction of the main trend, and then 3 waves against the trend.
So 8 waves in total.
Yes, exactly.
Okay, and where do Fibonacci numbers fit into this?
Right, so Elliott Wave theory uses Fibonacci ratios,
Okay.
like 61.8%, 38.2%, 161.8%, to try and predict how far these waves will move.
Okay, so you're using math to analyze these psychological patterns.
Essentially, yes. So, for example, you might look for a corrective wave to retrace to a 61.8% Fibonacci level
Okay.
of the previous wave.
Got it.
And that might be a signal that the trend is about to resume.
So someone using Elliott Wave might look at a chart,
Yeah.
identify these waves,
Right.
and then use Fibonacci ratios to figure out where the price might go next.
Precisely. This is called wave counting, and Fontanills suggests that it can be really useful for commodities because they're often cyclical.
Okay, because supply and demand, they go through cycles.
Exactly.
Are there any tips for someone who wants to try using Elliott Wave?
Sure, Fontanills talks about learning to identify the different types of waves, understanding the rules for how they form, and how to apply Fibonacci ratios.
Right.
He also emphasizes that you should combine Elliott Wave with other technical tools.
Okay, so don't just rely on Elliott Wave by itself.
Exactly. And it's important to remember that wave counting can be subjective.
Okay.
It takes practice and experience.
Right, it's not a magic bullet.
It's not, no.
All right, so we have all these analysis tools. Now let's talk about strategic trading, actually putting this into action.
Right.
Fontanills starts with options. What does he cover there?
So Fontanills is an options expert.
Right,
So
yeah.
he provides a really good foundation in how commodity options work.
Okay.
He explains calls and puts, strike prices, expiration dates, premiums.
Right, all the basics.
Exactly. And then he dives into different trading strategies.
Mhm.
For example, if you think the price of oil is going up,
Right.
you might buy call options. If you think gold is going down, you might buy put options.
Okay, and those are speculative trades.
Yes, exactly.
What about hedging?
Hedging is really important in commodity trading. Options can help you protect yourself.
Okay, how so?
So let's say you have a lot of aluminum
Okay.
and you're worried the price will drop. You could buy put options on aluminum futures
Okay.
to protect the value of your inventory.
So if the price drops, the options will make up for some of that loss.
Exactly.
Interesting.
Or if you're a natural gas producer, you could sell call options against your future production
Okay.
to lock in a minimum selling price.
Now, what about generating income with options? Is that possible?
It is. One common approach is selling covered calls.
Okay.
If you own the commodity or a futures contract,
Right.
you can sell calls against it. The premium you get provides income, but you also limit your potential upside.
Right, so it's a trade-off.
Exactly. Another strategy is selling cash-secured puts. Here, you sell a put option, and if the price falls below the strike price, you have to buy at that price.
Okay.
But you already got the premium as income. There are also strategies like straddles and strangles.
Those sound complicated.
They are a bit more complex,
Okay.
but they can be used to profit from volatility, regardless of which direction the price moves.
Now, you mentioned volatility earlier. How does that affect options?
Volatility is a huge factor in options pricing.
Okay.
It's basically the market's expectation of future price swings.
Right, how much it's going to move up and down.
Exactly. And this is reflected in the premium you pay for the option. Higher volatility, higher premium.
Makes sense.
And options are a great way to define and limit your risk.
Okay.
Because your maximum loss when you buy an option is usually limited to that premium.
Right, you can't lose more than you put in.
Exactly.
All right, risk management. That's a big one, especially with commodities.
It's huge.
Yeah.
You can't trade successfully without managing risk.
What are the key principles there?
So first you have position sizing. This is about how much you trade. You don't want to put all your eggs in one basket. Fontanills talks about risking a fixed percentage of your capital on each trade,
Right.
or adjusting your position based on the volatility.
So if it's a very volatile commodity,
Yes.
you trade a smaller amount.
Exactly. Stop-loss orders are also crucial.
Those are those orders that automatically sell if the price goes against you.
Right. They limit your losses. Fontanills is very clear. Use stop-loss orders on every trade.
Every trade.
Every trade.
Okay, I'll remember that.
And then there's risk-reward ratios. You want to look for trades where the potential profit is bigger than the potential loss.
Okay, so you're not risking $1 to make 50 cents.
Exactly.
Got it.
And diversification is important too. Don't just trade one commodity.
Spread your bets.
Exactly. Spread your bets, because different commodities don't always move together. And ultimately, the number one priority is capital preservation.
Protecting your money.
Yes, that's how you stay in the game.
Now, trading is psychological too, isn't it?
It is. It's very psychological.
What are some of the pitfalls there?
Well, you have fear and greed.
Right, those are the big ones.
The big ones. Fear makes you close winning trades too early.
Right, you're afraid of losing your profit.
Exactly. Greed makes you hold on to losing trades for too long.
Hoping it will turn around.
Exactly. Overconfidence after a win can lead to taking too much risk.
Right, you think you can't lose.
Yeah, it's a dangerous trap. And then you have revenge trading, where you try to make back losses quickly.
Ah, I've been there.
It's a natural reaction, but it's usually a bad idea.
Okay.
And then you have things like confirmation bias, where you only see what you want to see.
Right, you ignore the evidence that goes against you.
Exactly. And FOMO, the fear of missing out, which can lead to impulsive trades.
So how do you develop a good trading mindset?
Fontanills talks a lot about emotional discipline. This means sticking to your plan, no matter what.
Okay.
Patience is also key. Waiting for the right opportunities, not just trading for the sake of trading. Objectivity is important too, being honest with yourself about your performance.
Being able to admit when you're wrong.
Exactly. And resilience, bouncing back from losses. And perhaps most importantly, self-awareness.
Knowing yourself.
Exactly. Understanding your own tendencies and biases.
Are there any practical tips for that?
Sure. He recommends having a written trading plan.